Most people think that you need at least 20% down to buy a home, but that's simply not true. In fact, I've helped hundreds of people buy their first homes with little to nothing out of pocket without draining their savings or waiting years saving up for a large down payment. There are little known programs that'll help you do exactly that, and I'll be revealing exactly how you can access these programs and use them to finally get into your first home this year. I'll walk you through the programs, the strategies, and share with you real life examples of people who've used this program to buy their homes with way less money than they could have expected. Now, I've been helping people do exactly that for the last 10 years, and let me tell you, there's probably no better time than right now to buy your first home with $0 down. Let's get into it. Now, while I was doing some research, it shocked me to find out that 62% of Americans believe that they need 20% down to buy their first home. And it's a single misconception that's probably the #1 reason that most people are waiting far too long to buy their first home. So where exactly did the 20% down rule come from? Well, you might be just as surprised as I was when you find out that this rule for 20% down dates all the way back to the 1930s. You see, coming out of the Great Depression, the Federal Housing Administration, or FHA as it's known more commonly now, really wanted to spark homeownership. Now, the FHA has a lot to do with why neighborhoods look the way that they do, but they are probably the #1 reason why mortgages look the way they do as well. You see, in order to spark homeownership, they flipped the entire mortgage process on its head. They created what's called government-backed loans, meaning that the federal government would guarantee these loans in case of a default. And by doing so, they made some key changes to make homeownership significantly more affordable for everyone. The first biggest change is instead of a short-term loan of 5 to 7 years, they stretched it all the way out to what's known as the 30-year fixed loan that we see today. In addition, they dropped the 30% down payment requirement down to 20%, which is exactly where that misconception comes from. But fast forward to 2025 and the average home price is nearly $500,000. So 20% down is a significantly larger amount than it was back then. And so while the housing market in the United States has drastically transformed over the last 100 years, this piece of outdated advice has stubbornly persisted and honestly continues to affect homebuyers today. I want to be clear about one thing. Lenders don't require 20% down for the majority of loans out there. All a larger down payment does is help you avoid private mortgage insurance, or PMI for short, on conventional loans. But the reality is today that there are a number of different programs that simply don't have that requirement and can actually get you into a home with little to nothing out of pocket. And while the average down payment for most first-time homebuyers is anywhere from 8 to 10%, I think we can do a lot better. Now, it sounds crazy, but there are truly legitimate programs that'll help you buy your first home with 0% down. And if you combine that with some of the strategies that we're going to talk about in this video, you can actually buy a home with nothing out of pocket, or even end up getting some money back by the time you close. Now, probably the most common options that you've heard about for buying a home with 0% down are a VA loan or a USDA loan. Now, a VA loan is available to our veterans, but also our active duty members who might qualify for it. And because these loans are backed by the VA benefits, you can get into your first home with 0% down and no PMI using a VA loan. Now, what if you don't qualify for a VA loan because you aren't an active duty service member or you haven't served in the military? Well, the other more common option is something known as a USDA loan. These loans will let you buy in specific rural areas that you can actually look up on the USDA website to find out if it qualifies for this specific kind of program. Once again, you can buy a home with as little as 0% down as long as you meet some specific income requirements based on where you're buying. Now, these limits are going to depend based on the zip code that you're buying in, how many people are in your household, as well as your credit score. So make sure you check through the USDA's guidelines or get a loan officer like myself to walk you through this. While these loans are great for the people who can qualify for it, what about everybody else? Well, these two loans aren't the only programs. In fact, in America, there's over 2,000 different down payment assistance programs offered at the state and local level that can help you buy your first home with 0% down. And a lot of these programs aren't just home loans. A lot of them are grants as well, offering tens of thousands of dollars to help you buy your first home. That means if you know where to look, there's real money that can help you buy your first home that you never have to pay back. So where exactly can you find these programs and really verify if they're even legit and if you can qualify for them at all? Well, luckily, Fannie Mae actually has a great tool on their website that'll help you look up exactly what programs are available in your area and if you can even meet the requirements. And so check this out. I went ahead and used the Fannie Mae tool to look up the different programs that are available in San Diego County where I'm from. And there are 21 different programs that are offered in San Diego County that I might be eligible for if I was a first-time homebuyer. And check this out, right? Through the California Financing Agency, or CalHFA, they have their usual $21,000, $18,000 using their Cal Plus or their 0% interest program, right? These are second mortgages that you can get that aren't really paid on a monthly basis. There's some other programs, from the Federal Home Loan Bank, $30,000. Scrolling Scrolling down, Golden State Finance Authority has up to $28,000, $31,000 on here. And the San Diego Housing Commission, one program that we use pretty regularly here, has a program that gives 22% of the purchase price, up to $132,000. And there's some programs on here that are actually not even listed, right? San Diego has a great program that gives up to $50,000 between a loan and a grant. So there's some awesome programs that are there for the taking if you know where to look. Now, it's important to understand how these programs actually work, and it's usually one of three options. The first and probably the most common is a down payment assistance offered in the form of a second mortgage. It's usually just enough to cover that minimum down payment of 3 to 3.5% down and paired with a conventional or FHA loan. You typically don't have to make any monthly payments on that down payment assistance. You just have to pay it back when you sell the home or if you refinance. Now, the second type of down payment assistance is one that probably is a little bit more interesting, which is a grant. And as the name implies, as long as you meet the requirements, you don't have to pay that money back. Now, the third kind of down payment assistance is a newer and more novel concept. And probably the most famous use of this is the California Dream for All program that uses something called shared appreciation. So instead of offering the traditional down payment assistance loan or grant, it's this new kind of shared appreciation, which honestly I think is a new concept that'll be more popular as time goes on. The simplest way I could put it is instead of getting a loan that accrues interest over time, the bank will lend you the money for the down payment, but instead of collecting interest, they'll collect a portion of your equity when you sell the home later on. Now, obviously the big pro with these programs is it offers a way bigger down payment, usually 10, 15, or 20% down towards your first home, versus a traditional down payment assistance program, which usually only offers about 3 to 5% down. But the biggest downside, of course, is that you're sharing that appreciation with the bank later on versus just paying them interest over time. Now, you might be thinking as a first-time homebuyer, you automatically qualify for these programs, but that's not exactly true. You see, most of these programs have pretty strict income requirements, usually ranging between 80 to 120% of your area's median income. So while these programs are designed for first-time homebuyers, it's really more designed to help people that meet specific income requirements that may be having a harder time to get into a home in the first place. You see, while down payment assistance programs are a great benefit for being a first-time homebuyer, if you're somebody making $500,000 a year, you probably shouldn't be using one of these programs in the first place. And in addition to the income requirements, there's usually a minimum credit score of about 640 to 660 that's going to be required for majority of these programs. Now, if you want to figure out what the best kind of home loan program is for you, or if you even qualify for one of these in the first place, click the link below and schedule a one-on-one call with my team, and we'll be happy to help you figure that out. Now, while there are several different programs that are available, not all of them are as generous. So make sure you're taking your time and looking into the programs that are available to you and see if they actually make sense. So now that you're aware that these programs legitimately exist and where to find them, let me show you how you can actually use this program to buy a home with $0 down. So let's take a look at this real life example for one of my clients just a few months ago and how we were able to structure their deal to not only get them a home with $0 out of pocket, but they actually ended up getting money back at the end of the process. And let me show you how. So first, we'll compare it. It was a traditional $500,000 purchase. And when we were putting together the deal, we wanted to figure out if it made more sense for them to put their own money down or to use the down payment assistance program that they were eligible for. In this case, it was the Cal HAFA conventional program that offered 3% down for their down payment. So first, looking at the conventional loan, right, they were putting 3% down. They were going to pay for pretty much all of their closing costs originally. And their monthly payment was going to be just a little over $4,000 a month. And their total out of pocket would have been $27,000. Now, while that's probably a great deal for most people, we actually wanted to see if there was a way to structure this deal to come out with little to nothing out of pocket. You see, the most important thing to them at the time was making sure that they had as little money out of pocket as possible because they just had a newborn. And if you are just like me, who has a newborn at home, it can get pretty expensive pretty quickly. And especially as a first-time home buyer, you have a lot of other expenses that you might have to be paying for. So it was very important to those clients to come out with as little money out of pocket as possible while still having a really solid payment. So the Cal HAFA loan in this case was the one that made the most sense. So taking a look at the numbers, right? They were able to get a $500,000 home. They got $15,000 from Cal HAFA, and the interest rate was exactly the same as if they put their own money down. This is a very common misconception that most people believe that just because you're using a down payment assistance program, you're going to have a way higher interest rate. And that's simply not the case, at least not for every single one. And because we had taken the time to understand what their goals were and what programs made the most sense, we were able to accomplish both of their goals, having a great monthly payment and coming out with little to nothing out of pocket. So this is exactly how we structured their deal to make sure that they came out with nothing out of pocket and actually ended up getting their deposit back from the sale of the home. So check this out. With the Cal HAFA loan, the loan fees are often a little bit higher. In this case, it was about $3,000 higher than using their own money out of pocket. But otherwise, all the other fees were pretty much exactly the same. Taxes and insurance, third-party fees for title and escrow, they were all pretty much the same. Now, as I mentioned at the beginning of this video, there's probably no better time than right now to buy a home with $0 out of pocket. And the reason why is there's a lot less competition for homes right now because A, there's really high interest rates that most people are dealing with, and there's honestly not a lot of inventory out there. So as a result, sellers are a little bit more willing to give people money, especially buyers, to come in and buy their homes, and you can get a great deal on a property without having to lower the price. And so in this specific scenario, we were able to negotiate a seller credit of the maximum of 3%, or in this case, $15,000 to pay for all of our buyers' closing costs. Now, you'll notice the earnest money deposit of $5,000. That's pretty typical to make a deposit at the beginning of the process of 1%, and it usually goes towards your down payment and closing costs. But in this scenario, since Cal Hathel was covering the down payment and the seller was covering the closing costs, our client ended up buying this home with nothing out of pocket and ended up getting their deposit back. Now, while this specific example was a great win for these clients, not all down payment assistance programs are created equal. You see, while these assistance programs can definitely help open doors for home buyers, what's on the other side of them might surprise you. You see, when a bank is willing to lend you money with little to nothing down, they're not doing it out of generosity. What they're really doing is just shifting the risk and charging you in ways that might not be immediately obvious if you don't know what to look out for. Now, a few years ago, I actually made a video saying that down payment assistance programs are a scam because the way that they're marketed isn't exactly the most ethical. And if you don't know what to look out for, and if your lender isn't being very upfront with you, it can definitely feel that you might got scammed and you didn't really get as good of a deal as you possibly could have. Now, granted, it's been a few years since that video, and there are now way more options for first-time homebuyers that I personally believe are actually great options that are less scammy than what used to exist. But if you're going to be an educated homebuyer in this market, you need to know what to look out for. Probably the most common way that banks make up their money from using down payment assistance programs is by charging buyers a higher than market interest rate. Oftentimes, it's a rate that's anywhere from a half to sometimes even a full percentage higher than what you would get if you were putting your own money down on a loan. And so in real world dollars, that translates to a payment that can be anywhere from $200 to $300 more a month. But obviously the trade-off being that you're going to be getting down payment assistance in the form of a grant or a second lien on the mortgage that you're technically not having to make payments on. But of course, the reality is you are making payments on that money just by paying a higher interest rate instead. Now, the other and probably more common way that lenders make up the money by using down payment assistance programs is by charging higher upfront fees instead. Now, while most banks charge a standard 1 to 1.5%, which in my opinion is pretty small compared to what can be charged, and these fees can range anywhere from 2 to 3% of the loan amount, which ultimately ends up canceling out a lot of the benefit that you ended up getting down payment assistance in the first place. I mean, think about it. If you're getting 3% in down payment assistance and you're being charged 2% as an origination fee from a bank, you're really only getting a 1% difference towards your purchase of a home. Now, granted, a way around this is having a seller pay for your closing costs, but at the same time, you have to take into account that that's not going to happen all the time. Now, I'm not necessarily saying it's a bad thing that lenders charge either higher interest rates or higher fees in order to use these programs. After all, the money that they are charging help keep these programs going in the first place. But it's very important to understand that there's no circumstance where this money is free, and you have to understand what your trade-off is when you're using this program to really assess whether or not it makes sense for you to use down payment assistance, or if you have the ability to use your own money instead. I can't tell you how many times clients have come to me asking specifically to use a down payment assistance program, but by the time we looked at the numbers and we realized that, hey, you've got your own money for a down payment and you're going to get a way better interest rate, we decided that that was going to be the option that made the most sense because their monthly payment was the most important to them. But for other home buyers, your motivation might be the fact that you don't have any money right now to put towards a down payment, but you're tired of paying rent and you want to start building equity in a home a lot sooner. And so that's exactly the type of person that these down payment assistance programs are made for. And so it's really important to make sure that you're making an informed decision when you're considering using a down payment assistance program and understanding how that trade-off can translate to wealth or maybe even more costs for you later on if you decide to use them. So while you can absolutely buy a house with $0 down or even zero out of pocket in some cases, should you? I think it really just comes down to assessing what loan makes the most sense for your finances right now. If you're able to reasonably afford the payment and it makes sense for you to use the state's money or some of these programs' money instead of having to wait and save up even longer to get into a down payment, then yeah, it absolutely makes sense to use a down payment assistance program to get into a home and start building equity. But if you are in a position where you have some money saved up and you're thinking about using down payment assistance program, that's where the conversation gets a little bit more interesting. Ultimately, that decision comes down to weighing the pros and cons and figuring out if your monthly payment or your cash out of pocket is really going to be the most important thing to you when it comes to buying a home. But one thing is absolutely abundantly clear: there's no reason for you to be waiting until you have 20% down to buy your first property. In my 10 years of doing home loans, what I've realized more than anything else is it isn't about timing the market. It's about your time in the market. And the perfect time to buy a home shouldn't be dictated by some arbitrary threshold for you to meet in order to get financing. You'll know when you're ready to buy a home when you can reasonably afford a home that you love right now. And even if you figured out the perfect loan, there is a huge journey ahead of you, filled with obstacles, twists, and turns that might end up still costing you thousands of dollars if you make the wrong decisions. If that's where you're at in the home buying process right now, you're going to want to watch this video next, where I go over the entire home buying process from start to finish. By the end of it, you're going to know exactly what obstacles to avoid, what mistakes not to make, and some new strategies that you might not have ever heard from a lender or real estate agent ever that will be guaranteed to save you thousands of dollars.